Hey guys, what's up? Welcome back to another video. In this video, I'm going to be talking about a stock that recently announced earnings for the second quarter of 2023, and that stock is General Electric. And GE is slowly becoming one of the more interesting stocks in the market. We can see over the last year, the stock is up 100%, and there are some really strong catalysts coming up that are making GE a very attractive investment, a lot more attractive than they have been historically. So in this video, I'm going to talk about some of those catalysts and some of the recent news that came out surrounding GE. I'm going to look into their financial statements, and then I'm going to use a discounted cash flow model and the weighted average cost of GE's capital to figure out the intrinsic value per share for GE so we can know if this is a good price to buy into the stock from a value investing perspective. So right here in this article, it's titled GE Stock Surge Shows It's Possible to Turn Around a Legacy Company. And they talk about some really interesting points that are coming up surrounding GE and that have happened very recently. For starters, real quick, they point out that GE is a 125-year-old company, so they've been around for quite some time. In the first paragraph, they point out that the industry giant is less than a year away from achieving a multi-year turnaround that is currently transforming this once iconic but sprawling conglomerate into an aerospace-focused company, and the slimming down has Wall Street excited. Management's focus on cash flow, cleaning up their balance sheet, selling off assets, and paying down their debt is why the stock has recently hit 52-week highs. For starters, I point out that over the last year, the stock is up 100% and 72% year to date from the start of 2023. Also, they point out that historically, the conglomerate's portfolio at one point included lighting, home appliances, plastics, aircraft engines and medical equipment, financial services, water treatment, and even television stations. So they were spread pretty thin. They point out that they grew too large under their previous management teams, and their businesses didn't have a lot of synergy to their other businesses. Right here, they point out that they weren't focused closely in any one direction, and toward the end, they had overpaid for some assets, stretched their balance sheet, and ran into regulatory issues as a result of the financial crisis, so they were facing problems from a number of angles. It was so bad that in June 2018, the Dow Jones Industrial Average dropped General Electric after being in the index for more than 100 years. Shares fell 35% in 2018 after sinking 47% the year before. So business was really not looking that good for GE in 2017 and 2018. But they started making a turnaround through restructuring and through asset sales, which included the sale of their historic lighting business. And they also ended up reducing their debt by more than $100 billion since 2018. In November 2021, they announced a plan that was long speculated by Wall Street to split General Electric into three different companies: GE Aviation, GE Healthcare, and GE Energy. GE Healthcare was spun off and began trading on the NASDAQ at the start of 2023 in January as its own publicly traded company. So now if you go into the stock market and you search up GE Healthcare, you can see that that's its own company separate from General Electric. And then they also plan on separating their renewable energy and power unit, rebranded GE Vernova, at the start of 2024. So in the future, GE is mainly going to be an aviation business focused on GE Aerospace. And this is pretty good news because they're obviously slimming down. They're going to be able to focus their efforts a lot more as a company. And in the latest quarter, aerospace revenue rose 28%, orders increased 37%, and profit jumped by almost 30% year over year. So separating the conglomerate into three parts is really what's the main future catalyst for GE. Slimming down is really going to help them. So definitely super interested to see where the company goes from here. Right here, we can see their financial statements, their income statement, balance sheet, and cash flow statement is what we're going to be looking at. For starters, total revenue increased from $14 billion to $16.6 billion year over year. So that's an increase of about 18% year over year. Of this revenue, they break it up into their two main parts, GE Aerospace and their energy and power unit. Although it doesn't say it here, their aerospace revenue increased 28% year over year, and then their energy and power revenue increased 10% year over year from 7.3 billion to 8 billion. So very interesting. And then obviously, as I pointed out in the article, those businesses are going to be splitting up in the start of 2024. Right here, we can see that their net earnings increased from a net loss of $949 million to a net loss of $23 million. So that's an increase of 98% year over year. So they still have a net loss, but it's a much smaller net loss this quarter than it was in the second quarter of 2022. On page 20 right here, we can see their balance sheet. Total assets are down from $188 billion to $163 billion. And then we can see that most of their business is made up of liabilities. They have $130 billion of liabilities and $32 billion of total equity. And then of that, retained earnings has increased from $82 billion to $84 billion. Lastly, we can see their cash flow statement comparing the first half of 2022 to 2023. Their operating cash flow increased from operating cash used of $6 million in the first half of 2022 to operating cash flow of $215 million in the first half of 2023. So that's definitely a very positive sign. And then also in their financing activities, we can see that they paid out dividends to shareholders of $350 million. And then they also purchased common stock for treasury of $632 million in the first half of 2023. So they are prioritizing returning value back to shareholders, which is always good news for a company and for shareholders. So right here, this is the discounted cash flow model to figure out the intrinsic value per share for GE. We can see the growth rate I'm using right here is 11.29%. And that came from this historic growth rate calculation right here for GE. I started with their 2019 free cash flow, which was $2.96 billion, and then their ending free cash flow for 2022, which was $4.54 billion. I would usually compare the growth in cash flows over the last 5 years, but GE's 2018 free cash flow was negative, and you can't include a negative cash flow metric into a discounted cash flow model, otherwise it won't work. So I decided to use the last 4 years instead. As we saw from the article, 2018 was a really bad year for GE. They had negative cash flow, but they started to turn that around over the last 4 years. And so historically, over the last 4 years, growth rate was 11.29%, which is what I use for these growth rate estimates here. And then for the weighted average cost of capital, which I use to calculate the discount rate to discount the free cash flow to the present value of the free cash flows, came out to 5.27%. I got that using this weighted average cost of capital calculation here. We saw from their balance sheet that the book value of their equity to debt was mainly made up of debt. They are made up of around 80% debt and 20% equity. Their interest rate for their total debt in their most recent full year was about 6.07%. Their effective tax rate was 33%. The 10-year treasury yield right now is around 3.9%. GE's beta is 1.04. The average stock market return, 10%. And so the cost of equity, which I calculated by just taking the risk-free return, 10-year treasury yield, adding that to their beta, and then multiplying that by the average market return minus the risk-free return, came out to be 10.24%. And then in order to calculate the weighted average cost of capital, I just multiplied the equity proportion by their cost of equity, added that to the debt proportion, multiplied by the cost of debt, and then multiplied that by the tax shield, which is 1 minus the tax rate of 33.7%. That gave me the weighted average cost of GE's capital of 5.27%, which is what I used right here. Terminal value, 10. Free cash flow for their most recent full year, $4.5 billion. They have a net debt position of $8.8 billion, and they have a little over 1 billion shares outstanding. That puts their intrinsic value per share estimated to be about $89 per share, which means that at the moment, GE is not trading below intrinsic value per share since they're currently trading at $112 per share. So you probably want to buy them at a bit of a cheaper price if you wanted to buy them at their current intrinsic value per share based on these growth rate and weighted average cost of capital assumptions. So right here, I did a competitor/industry analysis comparing them to some other companies that are similar to conglomerates like 3M and Accenture. We can see that for gross profit margin, net profit margin, and return on assets, GE has the lowest these were their profit margins for their most recent full year, 2022. Hopefully they'll be able to turn that around in the future as they slim down. We can see that for their P ratio, they're currently trading at 14 times earnings, and they have a dividend yield of about 0.38%. So for every $100 you invest into GE, you're getting paid a dividend of about 38 cents per year. Pretty terrible dividend, but that is their dividend yield. So if you're comparing these companies against each other, it looks like from a profit margin perspective, at least for their last full year, which was 2022, you'd want to give it to 3M because they had the best profit margins and also the best dividend. But as we saw in the last video, 3M's business is deteriorating really quickly. They're definitely not currently in the middle of a turnaround the same way that General Electric is. So although 3M on this table currently looks like the best investment based on these profit margins and dividend yield, might not be too sure about that. You might want to do a little bit more due diligence because, the current news surrounding 3M isn't really that optimistic, whereas with GE it is. But based solely on these ratios and dividend yield, you'd probably want to give it to 3M for this competitor analysis. And then lastly, to end off the video, I wanted to compare GE to some of the other companies we've recently looked at. From an intrinsic value perspective, GE, their current share price is $113. Intrinsic value is about $89. So they're currently trading at around 1.27 times their estimated intrinsic value per share, puts them in 7th place on this table. Right now, Google, Alibaba, and Etsy are the only companies we've looked at that are trading below intrinsic value. For growth rate, GE had a projected growth rate or an estimated growth rate of around 11.29%. That puts them in last place on that table. We saw that for dividend yield. They had a pretty low dividend yield, but it's better than nothing. So that puts them in 7th place compared to all the other companies we've looked at since we added the dividend yield table. 3M actually had the highest dividend yield at almost 5%. We can see that for a year-over-year revenue growth and earnings growth right here. GE comes in 3rd place for second quarter revenue growth at 18% year over year. Tesla is first with 47%. And then they come in 2nd place with 98%. We saw that their net loss decreased significantly from around 900 million to only around 20 million. So that's an increase of around 98%, puts them at 2nd place. Kura Sushi had the highest with 240%. We saw that their profit margins of 27% for gross profit and 1% for net profit were really not that good. So they're not good enough to get them onto the tables here. Adobe and Occidental Petroleum hold the highest profit margins of any of the companies we've looked at historically. And then for stock performance over the last 5 years, we saw that GE is currently up around 38% over the last 5 years. So even though they're doing really good over the last year, over the last 5 years, if you include the 2017, 2018, 2019 years, they weren't really doing that good for stock performance. They're more recently starting to have a turnaround. So over the 5-year chart, they don't do well enough in order to make it onto the table. So far, Tesla is doing the best with a 1,144% return over the last 5 years. So based on this analysis, it looks like GE is very competitive in terms of second quarter revenue and earnings growth. But for stock performance, profitability, and growth rates, as well as dividend yield, they're not doing that well, but they were doing at least good enough from an intrinsic value standpoint to make it onto the table here, although they are not trading below intrinsic value per share based on the discounted cash flow model. And then we can see in terms of comparing them to the industry, right now, as of the most recent full year, they don't really look like they're that competitive, but we'll see if that's able to change as GE slims down and makes a turnaround, and also as 3M's business deteriorates for 2023. So let me know in the comment section down below what you guys think of General Electric. Leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.